In this week's video, we'll be covering two new long-term developments and their possible impact on the stock market. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. Regular viewers of these videos know that when we see something on multiple time frames, let's say daily, weekly, and monthly, that evidence starts to become more powerful. We recently covered some potentially bullish developments using weekly RSI, and in the first major portion of this week's video, we'll be covering some developments looking at monthly RSI. This is the S&P 500 index here. This is calendar year 1982. 1985. Weekly RSI here where my cursor is comes down to the center line, our 50, and holds near the green arrow, and then quickly makes it back to 70 and moves in to overbought territory. As we covered in that weekly analysis, quote-unquote overbought isn't necessarily bad, and in this case, after RSI on the monthly chart held above 50 and quickly moved back above 70, after that, the S&P 500 rallied roughly 83% over a very long period of time. These two instances are a little bit different. RSI comes back down below 50 before rallying, and not too many similarities between this period here and this period here. If we fast forward to calendar year 1994, this is starting to look a little bit more like this. You can see, unlike these periods here, the market was strong enough for monthly RSI to rally above the 50 line. And then in a very similar manner to this case, where we rallied relatively quickly back above 70, we come from 50 and come back above 70. In this case, after that, good things happened. The same can be said for this case in early 1995. After the rally and retaking RSI 70, the S&P 500 monthly chart rallied a little bit over 200%, and the rally lasted several years. During this period here, RSI drops well below 50, and we do get a rally back above RSI 70, but it's quite a bit different than these periods. This is a quick move from 50 to 70, a relatively rapid move from 50 to 70. This is not a rapid move. It takes us several years to get from 50 to 70, but when we get to 70, the market still rallied even in this case, although it's not particularly similar to these cases here. If we fast forward to calendar year 2011, we see RSI trying to hold near 50. It's similar to these two periods, but the market's definitely a little bit weaker from an RSI perspective. And in this case, RSI rallies back above 70 in a relatively rapid manner. These two cases are very similar. This case here is somewhat similar. After RSI rallied back above 70, what happened next? For the most part, monthly RSI stayed in quote-unquote overbought territory, and the stock market rallied roughly 42% from point A to point B. If we fast forward to calendar year 2015, early 2016, you can see monthly RSI is trying to make a stand at the 50 or center line here. This is similar to this and also similar to this period here. And in the present day case, RSI holds near 50 and then rallies relatively quickly back above 70. And the reason for covering this now, at the end of February, we had the first monthly close. This is a monthly chart, so we need to see if it holds into month end. We had the first monthly close with RSI above 70. So you can make an argument that this period here is similar to this point here, and somewhat similar to this point here. Similar to the weekly RSI analysis, There's nothing particularly bearish about RSI staying in overbought territory. In fact, RSI staying above 70 and holding above 70 is a sign of strength. Therefore, in the present day, the longer RSI monthly can hold above 70, and the more this period here can start to morph into something like this period here, this period here, or this period here, the more meaningful it becomes. Have we covered anything else recently? This is early 1995. The answer is yes. This week on See It Market, we covered a new Bollinger Band signal. This is 1995 here. Remember, we just looked at early 1995 with monthly RSI. This is a monthly Bollinger Band analysis. Won't go through this in detail because you can read it on See It Market. In this case, we have a price surge here, which is similar to the price surge here in the present day. In the 1995 example, what happened after the price surge? Stocks rallied strongly. The S&P 500 tacked on roughly an additional 28% over the next 10 months. We have a similar setup in the present day. It can't predict the future. It simply helps us with probabilities. You can find a detailed discussion of these charts and additional charts by Googling this title here and reading the post on See It Market. Now we're going to shift gears to the second new and major development. This is something that we have not covered in the past. We're going to start with some generic concepts, and then we'll tie these concepts into the present day or calendar year 2017. Market fractals tell us that price action on this chart is basically identical. We see similar things or identical patterns in price movements on 1-minute charts, 5-minute charts, 10-minute charts, 30-minute charts, 60-minute charts, etc. We really don't have to know what scale we're looking at to perform technical analysis. So let's assume for the moment we're looking at a 60-minute chart. If we had a 60-minute chart that was holding at the lower end of this range here and being rejected at the upper end of this range here, we would probably call this a trading range on the 60-minute chart. And the number of times that price has hit the upper and lower end of the range is significant. This is from Investopedia. Typically, the more times price bounces back and forth between the range, the more powerful the move may be once price breaks through. This is considered true for touches along uptrend lines and downtrend lines. The more times price touches the same trend line, the greater the potential for the move once price breaks through. So it's basically saying when price touches the top of the box and the bottom of the box for a total of 8 times, we have a greater potential for a significant move once price breaks out, as it has here in our hypothetical example. Now remember, we said market fractals tell us that the same principles can be taken from our 60-minute chart down to a 1-minute chart, or we could take them all the way out to an annual chart. Now it's time to tie in our hypothetical chart to the present day. We've actually been looking at the value line geometric index from 1982 to 2017. So we were not looking at a 60-minute chart. We're looking at a monthly chart as of the end of February. This is February 28th, 2017. The value line geometric composite index is basically an equally weighted price index of all stocks covered in the value line investment survey. So this is a very broad index, contains numerous stocks, quite a bit more than the Dow as an example, and it's equally weighted. Equally weighted indices give us a better indication of the health of the entire market. And it may turn out to be very, very important that the value line geometric index has been inside of this box since roughly entering it in 1982, and it touched the upper and lower end of the box approximately 8 times before breaking out and closing above the top end of the range. This was prior resistance here, prior resistance here. What once was resistance may now act as support. The more times price touches the same trend line, 1984, 1987, 1990, 1998, 2002, 2007, 2009, 2014, the more times price touches the same trend line, the same concepts apply to the upper and lower ends of a trading range, the greater the potential move once price breaks through. We also know the longer a market goes sideways, the bigger the move that we can expect to get when we either get a bullish breakout or a bearish breakdown. And in this case, the value line geometric index has been consolidating inside of this orange box for 35 years. Here are the years here, and here's what appears to be a bullish breakout. The longer price holds the breakout, the more relevant it becomes. Like everything we cover in these videos, this chart cannot predict the future. It just helps us with probabilities. And it's logical to surmise that 35 years of consolidation falls into the greater the potential move once price breaks through category. I want to shift gears for a moment to position management. We often talk about harder markets being followed by easier markets, and thankfully, that is actually playing out. The vast majority of our ETFs are performing fine. In fact, we spot checked one account that makes all the trades in the growth model, and from November 4th, which was the Friday before the election, to the point in time we checked it this week, it was up 11.33%. telling us that most of our ETFs are doing just fine. Not all of them. XRT is at a loss right now. We already sold half of the position. Why have we not sold the other half? We can see XRT, for the most part, is still in an uptrend. It's making a series of higher highs. This high is higher than this high. This high here is higher than this high. And a series of higher lows. A higher low, and so far, a higher low. As we noted on Twitter, the market will decide if the remaining position in XRT is held or eliminated. Our downside, somewhere in this area here. If it can't hold here, the rules will probably call for complete elimination of XRT. But our upside, if we rally back to the top of the channel, is decent. Hence, the rationale for being patient to see what happens. We also have revisited a gap. We know markets like to revisit gaps. So we have a gap, the 50% retracement, the 61.8% retracement, and these trend lines. We have no bias whatsoever relative to keeping or selling XRT. The market will decide. And this may be a good time to talk about how we manage risk. We manage risk by two major factors: our entry point, our profit and loss on the position, and the position size. Our original stake in XRT was roughly 3.6% of our entire portfolio. If you lose 5.27% on 3.6% of your assets, the hit to your entire portfolio is relatively small. It's 0.19%. It's very, very important to look at our gain-loss in the context of the position size. To put a 0.19% draw on the entire portfolio in perspective, when we bought XRT, 96.4% of our assets were in other ETFs not known as XRT. To regain the 0.19% draw on the total portfolio caused by XRT, the other ETFs would need to gain 0.196 one time. And as we know in the markets, that can happen in a matter of seconds. Therefore, we can't just look at a roughly 5% loss in XRT. We have to take into consideration our exposure. If 30% of our portfolios were in XRT, we may have managed the position in a different manner. We're also keeping an eye on energy. Looks like a normal pullback within the context of an ongoing uptrend. But in terms of weaker sisters, this is one of our weaker sisters, and the market will decide whether we hold or sell XLE. The market model helps us with one major risk management premise to help us distinguish between volatility to ignore within the context of an ongoing uptrend and volatility to respect, because the odds say this is going to be followed by lower lows rather than higher highs. Therefore, if we think the present day holding at 50, rallying strongly above 70, holding at 50, rallying relatively quickly above 70, holding near 50 and rallying relatively quickly back above 70, these three periods in time are similar to the present day, holding, rallying relatively quickly. If that's the case, we might be able to learn something about volatility to ignore relative to volatility to respect going forward by studying these cases. The shortest case, this case, was roughly 580 trading days. So therefore, we decided to look 580 days out from this point, which is similar to today, this point, which is similar to the present day, and this point here, which is similar to the present day. Our objective here is not to forecast, but to better understand volatility and profit profiles, potential volatility and profit profiles going forward. If we look at the average path the S&P 500 took for these cases, looking out 580 trading days, which is 2.3 calendar years, we can see good things happen, and there was some volatility along the way. This isn't particularly helpful because it understates volatility and overstates compounding, but it gives us a general idea of where the stock market went in terms of an average path. What's more helpful is to look at the cases in isolation, because then we can see real volatility profiles. In the 1985 case, if we looked out 580 trading days, or approximately 2.3 calendar years, the stock market went up roughly 74% from point A to point B. Point A is similar to the present day based on monthly RSI. But in order to capture the 74% gain, you had to withstand a lot of volatility along the way. This is the 1985 case, or case 1. If we look at the 1995 case, or case 2, similar situation. The present day is similar to a period in 1995. If we followed the same path in 2017, so roughly 2360, on the S&P 500, and we followed the same path that stocks did in 1995, looking out 580 trading days. In this case, the gain would have been, hypothetically, 82%, and we would have rallied, if we followed the same path, from March of 2017 all the way till June of 2019. And once again, to capture the 82% gain in this hypothetical scenario, you had to withstand volatility along the way. Similar situation, we're looking at if the stock market followed the same path that it did in the 2013 case. We start in March of 2017 at 2360. Roughly, we would rally for 2.3 calendar years, or 580 trading days, and the gain in this case, hypothetically, would be 41% when we reached June of 2019. We're not forecasting here. The primary purpose is to understand that volatility will occur along the way, and how much volatility can we expect within the context of an ongoing uptrend. So from a conceptual standpoint, we're illustrating concepts here, generic concepts. How would something like the CCM market model help us discern between volatility to ignore and volatility to respect? It sounds very, very easy to say that we're going to ignore volatility, but how do we do it in the real world? This is the hypothetical case if the present day looked like 2013, this is the real world case. 2013 monthly RSI was similar in February of 2013, and this is the path the market took in the next 580 trading days. Again, it sounds very, very easy to classify this as volatility to ignore after the fact. Managing against volatile price in isolation can be difficult. It's much, much easier to add in some trend following components to help us discern between volatility to ignore and volatility to respect. In this case, we've added in our generic and for illustrative purposes only 30, 40, and 50-week moving averages. And you can see during the entire 580 trading days, we maintained a full-bore bullish look with blue, the fastest moving average, on top. And for the most part, the slopes of all of the moving averages were positive. And for the most part, price stayed above all of the moving averages. If this is volatility to ignore, what might volatility to respect look like? This is a full-bore bullish look. This is a full-bore bearish look. These are the same 30, 40, and 50-week generic moving averages here. Now we have blue, the fastest moving average, on the bottom, and that's in early 2008 when the S&P 500 was still trading at 1396. Blue is on the bottom, and the slopes of all of them are down. After we could see this, the S&P 500 lost an additional 52%. If you watch these videos on a regular basis, you may remember a few weeks or maybe even a few months ago, we said it's important not to get too cute when the trends are strong, hence why we have been holding for the most part. The 1995 case is an extremely strong trend. And when you have an extremely strong trend, you can go a very long period of time before getting a significant pullback. In this case, we did not see a 5% pullback on a closing basis for 290 some odd trading days. This is over a full calendar year. As long as the charts allow in this type of environment, all things being equal, we want to look the other way when volatility comes and hold. Why? Because volatility to ignore, from an odds perspective, most likely will be followed by higher highs and a better P&L. This is our 1995 case. Remember, monthly RSI at this point in April of 1995 looks similar to monthly RSI at the end of February in 2017. Sounds easy to classify this as volatility to ignore or to classify this as volatility to ignore. But looking at this chart, it doesn't look particularly easy. It's much, much easier to manage against trend following tools that filter out day-to-day volatility. The 30, 40, and 50-week generic and for illustrative purposes only moving averages maintained a full-bore bullish look for the most part during the entire 580 trading days, helping us classify this as volatility to ignore, and this is volatility to ignore within the context of an ongoing and already established bullish trend. If the present day followed that 1985 path, it wouldn't be particularly easy to classify these as volatility to ignore by just looking at price. If we look at the actual example, 1985, where RSI in April of 1985 is similar to RSI at the end of February 2017, we get 3 significant pullbacks during the 580 trading days, but the underlying trends remained strong. During the entire move, blue, the fastest moving average, stays on top, and for the most part, we have positive slopes from point A to point B, and for the most part, price stays above all 3 of the weekly moving averages. It's also important to note the entire period from April 1985 into 1987, the trend following tools or the moving averages never morph into a concerning look like this look in the year 2000. After we could see the full-bore bearish look, bad things happened in the stock market. How do the same moving averages look as of March 3rd, 2017? The answer is we have a full-bore bullish look. This look here looks a lot more like this look here than this concerning look here as the market was rolling over late in calendar year 2000. After this point, the S&P 500 lost an additional 47%. In fact, the present day, March of 2017, looks more like the bullish turn in 2003 after the dot-com bear market. We have a turn, we have a similar turn here, and the present day also looks a lot more like the bullish turn in 2009 than the bearish turn in calendar year 2000. Is it possible that this chart here morphs into a look like this? We know the answer. It's absolutely positively yes, but it hasn't happened yet. And if we took that attitude from April of 1985 into 1987, it would have helped us stay with what turned out to be a very strong and long-lasting bullish trend. Is there anything else that we haven't covered in these videos in the past that aligns with this type of analysis or leans bullish from a longer-term perspective? The answer is yes. On short takes, we recently covered these moves here in the True Strength Index. You can find the charts and the analysis by Googling this title here. And from a weight of the evidence perspective, we've been covering bullish developments dating all the way back to August 5th. And in the present day, we still have a lot of constructive evidence that tells us to keep an open mind about better than expected outcomes based on the information that we have in hand today. Why are we constantly covering volatility in these videos? Because it's inevitable that uncomfortable periods will come within the context of even the strongest trends. Our goal is to capture a significant portion of the move from point A to point B. In this hypothetical example, it was 82%. The only way we can do that and stay on track between point A and point B is to maintain our long-term focus as long as the hard data allows, rather than constantly worrying about the potential for a pullback. In the three cases that we just studied, the average pullback was roughly 5%, the median pullback we covered was roughly 5%, and 73% of the pullbacks that we've shown in this video were less than 6%. Think of the magnitude of these pullbacks, and we're focusing on this relative to the magnitude of the potential gain if we can remain disciplined as long as the math and the hard data allow, as they have for the past few weeks and months. One of the key principles that we're trying to get across in these videos is captured in this quote. This is from Market Wizards. The question was, in other words, in order to score the really large gains, like 82%, you have to be willing to see those gains erode significantly before getting out of the market. That's a question. Here's the answer from the Market Wizard. I can't see any other way. If you get too careful about not risking your gains, you're not going to be able to extract a large profit. If you never allow your gains to run to 10%, 15%, 20%, 25%, 30%, 40%, 50% in some cases, it's mathematically impossible to ever book an 82% gain. Studying the historical cases also helps us understand what pullbacks might look like within the context of an ongoing uptrend. These are the pullbacks that we've studied in the historical cases. If the S&P 500 pulled back from 2382, was trading at 2382 during the session on March 3rd, 2017, if we saw similar pullbacks, we could pull all the way back to 2153 in the worst case scenario from a hypothetical perspective. This figure here is interesting and relevant because if we put those pullbacks on a graph, this is March 2nd, 2017, in every single case, if we're looking at 1985, 1995, 2013, all of those historical pullbacks would allow price to maintain the bullish breakout from the long-term consolidation box. The top of this is roughly 2134. The largest pullback that we've covered would take us to roughly 2150. And if we add in our fibs, this A to B move here and this A to B move here, we can see that it would be normal for the market to pull back, frankly, to any one of these pink lines here. That type of pullback could be a normal pullback within the context of an ongoing and established bullish trend. Quick example of filtering out volatility. If you stop the video and study these two charts, it's very, very difficult to discern any real difference. The chart on the left is moving averages on March 1st when the S&P 500 gained 32 points, and the chart on the right shows the exact same moving averages on March 2nd when the S&P 500 lost 14 points. It's much, much easier to maintain our focus on the longer term rather than the emotional roller coaster that we get by watching price tick by tick. Therefore, as we head into next week and into every week, we know if we pay attention to the hard data, the models, the evidence, follow the rules, rather than maintaining our focus solely on volatile price, the trend following tools will help us stay invested during volatility to ignore as long as the hard data allows. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.